Yes, if I start, Ole Hjertaker, CEO of SFL Corporation. I'm the bellboy this week. Had the pleasure of opening the New York Stock Exchange on Monday, commemorating our 20th year anniversary, where we have paid $2.7 billion of dividends over that period. And for those who wonder, that means 270 tons of dollar bills. So it's a shipload of dividends.
Hi, I'm Jeff Pribor, the CFO of International Seaways. We're 6.5 years old, but that's in the context of being spun out from OSG, which is like 60 years old. So we have a young company with a long history, and we're paying a lot of dividends too.
Yeah. You're Ted.
I'm Ted Young. I'm the CFO of Dorian LPG. I'm not as witty as those two, so I have really nothing else to add.
Yeah,
That was witty.
my name is Svein Engh. I'm the portfolio manager of EnTrust Global's Blue Ocean Maritime Fund business. We do mostly lending, but we also do equity investments. We have a very broad mandate. We've been around for 8.5 years now and have raised quite a lot of money and also distributed a lot of cash back, not through dividends, but just distributions to our private investors. I feel like a bit of an oddball. These are all public companies, whereas we are quite private in our business.
Moritz? Yeah, my name is Moritz Fuhrmann. I'm the co-CEO and CFO of NPC Containerships. We're a company, also a fairly young company, of 60 ships on the water. We've been starting in 2017, which seemed to be a nice time to buy container ships, but it's been a bit of a rough patch up until post-COVID, and then using the fantastic markets to also start cranking out a lot of dividends, making our shareholders hopefully very happy.
Wonderful, fantastic all. In addition to being just good guys on this stage with a lot of history, you know, what I'm really excited about as far as this panel goes too is all of these businesses are very different. So it's not going to be like going down the roster and asking the same question and getting 5 different answers that are kind of similar. This is going to be, you know, hopefully very different and you know, definitely conversational. So Ole, starting with you. And you know, the first question is going to be, I think, the best. Everything else is going to be boring after this, so take as much time as you want. But when you think about capital allocation and the topic of the panel, and thinking about not just theory, but you know, things that you guys have done either recently or in the not too distant past, what's a good example of something that you've done where capital allocation is factored into your decision making? And take as much time as you want, because like I said, it's a very...
You have time to fill, is what you're saying.
Well, there's that, but it's also a real question, right? It's like, I mean, we're going to talk about interest rates and all that stuff later, but I'm talking like, give everyone an insight into how you guys think about your investment decisions and how you allocate your capital in a real live type of a way.
No, yeah, it's an interesting question. It takes a lot of hard work to do it. And if you look at the team up here now, it's only Svein who's got what I would call a diversified type of portfolio. More finance, call it angled. The other guys have operational, they're single segment focused. We believe diversification will save you through the cycles. And it's so simple. I mean, the previous presentation about raising capital, etc. Nobody, you know, the problem is that it's really at the peak of the market. That's when the capital market is open. That's when the bank will lend you the most money. So you're almost programmed to raise money when you really shouldn't, because again, shipping has always been cyclical. I think it will continue to be cyclical going forward. Right now we've got a super compelling order book ratio, which is interesting, but you know, you can fix that in a couple of years and you're back in your cyclical sort of trend. So being able to play different segments across between each other and benchmark, I think, is the way to you know, survive and excel in this market, as we have seen over time. And if we started as a pure tanker owning entity back in 2004, 20 years ago, then we started diversifying the portfolio. Company would have been bankrupt in 2011 when Frontline went bust. You know, was saved out of court, but you know, was restructured. Right. So but then we have diversified into other segments. And then when the energy market collapsed, we had a lot of offshore assets, etc. But then we have invested so much into the liner business that we're still profitable, you know, despite that downturn. So I think that's one of the key reasons for surviving in this market. And unfortunately, you know, 3 of my panelists here may be on the track to go bankrupt again. I don't know.
So Jeff, once again, Same question, and it's going to be a different answer because you have a different business model, obviously, than ship finance. But I don't know if you want to go all the way back to the Diamond S transaction or if you want to do something more recent than that. But how does that factor into what you guys do?
No, I'd like to impart a takeaway. Capital allocation is so obviously something we care about. If you don't love it, you're in the wrong business because we talk about it every day. But it's also an overly hyped, overused term. In fact, you can turn on the TV and hear someone talking about capital allocation, meaning whether they're investing in bonds or stocks. That's not what we're talking about here. So I want to be clear, at least from the perspective of a tanker owner, but I think it would be true for dry bulk and other sectors. If you're looking at investing, what are we as companies doing in terms of capital allocation? What do we mean by that? And that's across the board, not just International Seaways. So it's not, and actually yours is a little different. It's like how you're going to allocate, diversify into different segments. I'm already in a segment, it's tankers, right? So I've got people that generate a lot of revenue and a lot of EBITDA, then it comes over to me. How do I allocate the capital? And then it comes down to, starts with free cash flow. And you know what? That's not understood, not well understood concept. What is cash flow? Free cash flow, operating cash flow, who knows? One of the better analysts, Doug, you paid for the plug, so I'll give it for you. One of the better analysts here is Omar Nakta. He reports free cash flow. It's really simple, guys and women. It's EBITDA less maintenance CapEx, which for us, me, is dry docking, less debt service, which is interest and principal, less working capital up or down, but let's assume that's flat because it tends to go up and down. That's your free cash flow. And that's what you have to work with. Now, in 2021, there was no free cash flow, so there's no capital to allocate. Since then, thankfully, we've had lots of free cash flow, and the question is what to do with it. That's what the company's job is. We have allocated, to answer your question, last year, we put about half of that free cash flow into paying down debt, and the other half we gave back in a dividend, a regular dividend, and supplemented it, added a 15% yield. This year, we've paid down enough debt, we're low levered enough, so we're continuing to pay down enough debt so our leverage is low. We're focusing on fleet renewal and dividend. And our last dividend was annualized. It's a 60% of net income. It works out to about 12% yield. So that's our view.
Okay, gotcha. And then Ted, you guys run an LPG company, obviously. So similar in that you're in a single sector, same as Jeff. But how do you guys think about that topic whenever you're making decisions, whether investment decisions, dividend decisions, et cetera?
I'm trying to read Jeff's crib notes, see if there's anything good to use, but I can't make out his handwriting. Yeah, look.
That was always my secret.
Damn, and the bad handwriting?
Yeah.
Oh. I'm going to note that down. Yeah, so from a Dorian perspective, I think Jeff did a great job, reminding us all what free cash flow is because it does get lost in the shuffle quite a bit. Obviously, as Brendan Dyson talked about, we have a lot of volatility in our business. So we went through 2016 to 18 in our sector, which was pretty rough. We were below cash cost per day. And anybody who's been in an investor meeting with me knows that that's my favorite thing to talk about is our cash cost per day. Because when you've been through the bottom of the cycle, that's all that matters is cash break even. So when the hedge fund guys, I don't know if any of them's in the room, but when they ask, well, how do you dimensionalize debt? Do you look at debt to EBITDA? Do you look at debt as a percentage of total cap? I said no. We live and die by cash cost per day because as one of our lenders reminded me, no shipping company has ever gone out of business for tripping an LTV covenant. They run out of cash first. And so from our perspective, as we've built up cash and come out of that swoon, our first goal was to build a strong balance sheet. I certainly won't go the Jamie Dimon Fortress balance sheet because I'm not sure what that looks like in shipping, and I don't think that it's probably right given the volatility in shipping and the need to reward shareholders of the sector. But we've now built up sufficient cash and paid down debt that we feel, okay, we're in good shape. And so we, like others on the panel, have been blessed to have some free cash flow to play with. And we've sort of tried, I would say, all three of the traditional levers of returning capital to shareholders. We've done open market repurchases. From a retrospective perspective, we really didn't see it generate a lot of total shareholder return. We did a self-tender offer in 21, which with 2020 hindsight worked out pretty well. You never know at the time, but we repurchased about nearly 13% of the company at a share price at $12.50, and we closed yesterday at 42 and change, and there's also about the same amount of dividends, $12.50 a share, that were paid out over that time period. So that worked out pretty well. But you are making an implicit bet on where you are in the cycle, and and whether that's indeed a good investment, because it could have gone sideways. Where we've seen the biggest impact from a total shareholder return perspective has clearly been dividends. We've been payers of a irregular dividend. Everybody likes to say it's regular because it's been the same number for many quarters, but it is irregular because shipping rates are irregular. If I had 100% of my fleet on time charter, I might consider a regular dividend, but we don't. We've paid out very steadily $1 a share. Shareholders have rewarded us with a good stock price and a good total shareholder return. Sort of picking up on Ole's point, it's an interesting time in the cycle. You've got to be careful. We've all, we really suffered. 3 years was a really long time to go through a down market. So we're very mindful of when we're looking at investment opportunities. We really haven't changed our internal IRR thresholds. We've sort of eschewed paying down debt because we're really happy. Our total all-in cost of debt is about 4.7%. So that's pretty cheap. There's not really a need to manage that down further. It fits into our cash cost structure. So, the next obvious thing is after we've rewarded shareholders, let's look at new investment opportunities. And I think that's the trick. I'm not sure diversification makes sense in our world. Investors can usually diversify better than we can as management, but we're open to it. And then it's looking at all the rest of the opportunities. But again, I think the trick is don't get excited by the market. Don't be overly exuberant. And I think that's how we get there, and I've run way over, so my apologies to my fellow panelists.
That's very insightful, Ted. So Svein, we want to come back to you, or do you want to take it head on?
I can go.
Okay.
Well, first of all, I feel even more like an oddball now, but I think Ole B made some very good points. Certainly for us, it's very, very important that we can do a lot of different things. When we started Blue Ocean 8.5 years ago, we made sure that we had the ability to do a lot of different things, and not just focus on, say, leasing or secondary market or whatever. We wanted to be able to lend across the capital structure. We wanted to be able to do equity, and that's what we've been doing, because unless you have a broad mandate as an asset manager, it's very, very difficult to grow. And if you don't grow in this business, you're dead. That's just the way it is. And we're actually seeing now a lot of the other guys that came behind us when, on the asset management side, they've been struggling in terms of growth because they've just been focused on maybe one thing. And this was very well articulated by my colleague Omer Donnerstein during another panel here this week, having the ability to really play across all the different sectors, all across the capital structure. That's why we have been successful. Now, in order to do that, you obviously have to have the right team, and that's why we've been building what we have in-house within EnTrust Global. We're now a team, believe it or not, of 27 people. I think about half the audience here is actually part of the team now, if you look in the back of the room. So, but that's what's allowing us to really grow the business the way that we have. We have one very, very clear underlying principle. So that's why I like what Ole B said. We are very counter-cyclical, because we can be. We're not relying on the capital markets for funding. We're not relying on the banks. We are raising capital, and we don't have any debt in our fund. We're investing all equity. And our capital is very, very broad. It's very institutional, but we have investors across the pension area, insurance companies, sovereign wealth, family offices, and so on. So this is very, very sticky capital, and we have long-term capital as well. So that's the kind of like the blend for our success.
Yeah, very good, very good. And Moritz, from a container standpoint.
Yes, so from our perspective at MPCC, we are very much focused on managing residual risk, especially when you look at the transaction on an asset level. So either year is good to buy at residual risk if the timing is right. If not, if the vessel values are staying at an elevated level as they are now, at least from a container perspective, then we would try, or I guess you need to try to combine those transactions with a time charter that's de-risking your investment. And I think now is a very interesting time, or a window that allows you to do those transactions. So it's really about to get your skates on because those windows are closing, quite quickly again. When we look at NPCC from a corporate perspective, and we heard the word volatility quite a lot just now, And I obviously agree. So from a corporate perspective, what we're trying to do is to keep the leverage as low as possible, which makes sense because shipping is so volatile. And we also try to keep a large chunk of the fleet unencumbered for the tough times to, in case you need to raise some more cash. And, in terms of capital allocation, yes, so the last 2 years we've been repaying debt in the tune of 300 million and paying out dividends in the tune of 900 million. But if I look ahead and, considering the age of the NPCC fleet, which is 16 years, so fleet renewal is quite important for us. It makes it a bit difficult for us, especially as opposed to the private peers, right? They have not been...
We may have some ships for you then.
Okay, let's talk after the meeting. The private companies, family-owned, they have retained the cash on the balance sheet, so they might have more flexibility and firepower looking at deals on an unlevered basis and be able to move quicker in the market. So for us, it's always a bit of a fine balance. So if we look at new transaction, obviously leverage is part of the equation when it comes to the capital structure. So it's a fine balance between not to over-lever too much and keep some flexibility going forward in terms of dividend capacity.
All very helpful, very insightful. Before we go to the next topic, we heard a lot of similarities, some differences. Any strong opinions as far as hearing something that you might disagree with, or that? Well, I see you're shaking your head a little bit.
I was just, interesting what you said about leverage and delevering. There is a very prominent shipping investor who incidentally was the chairman of SFL from the outset, who was at this conference some years ago, and he said, low leverage is for lazy management. So you've been delevering too, haven't you, Jeff?
I'm pretty lazy.
Anyone else?
Is that it? That's the best you got? Yeah, well, if you want to put $20 billion behind SFL, it's kind of easy to run a company when you got that backstop, huh? Okay. What bad could happen?
Well, and look, that's been part of your chairman's brilliance over time, right? I mean, no bank has ever lost a dime in shipping. Won't talk about offshore, but absolutely brilliant strategy. But for the rest of us who have more traditional shareholder bases, I think there's a balance to be struck, right? I think it's going to be interesting to continue to watch some of our peers in various sectors who are going with very low leverage models. Let's see if they get rewarded. Traditional shipping finance lore would hold that you want to have that leverage to enjoy the upside in asset values. But it's obviously tricky to time that because, leveraging up at the bottom of the cycle is brilliant. But if we all knew when the bottom of the cycle was here, very few of us would be here. We'd all be celebrating on our yachts somewhere.
Yeah. And just to give a more serious answer to your question, no, not yours was, but this guy's not been serious with me. No, it's low leverage this is a point in time, right? So we made a decision last year. Say there's all this boatload, pardon the pun, of cash coming in. Some companies went to delever all, no returns. Others went to none of that. We said we can balance a good return and a lot of deleveraging. We got down to below 15% net loan to value. That's not because we think that's the right place to be. It's for the long term. It's optionality. It's when that next transaction goes, that leverage is going to go way up again because we're going to find the right thing to buy. So I think it's a moment in time.
I think this conversation might be more interesting in a couple of years.
Well, yeah, and of course there is one important factor here is that we're talking about markets where you over time, if you're in the spot market, like classic tankers, bulkers, historically it's been the return has been mid-single digits. So you really have to have leverage to get the returns to attract investors into this industry because investors if they're happy with the mid-single digit, they buy something else. Well,
and also, I mean, look. The biggest boost to the equity IRR of any shipping deal is the exit, right? Because, as the old saying goes, right, trading is the boring thing that owners do between buying and selling, right? And so you're right. Trading, I mean, look, we've all enjoyed some good markets, some real upsides, and been able to pay off some dividends. But the real juice in the story is timing the exit properly, which, but it's impossible to model. It's absolutely impossible to model.
And I don't want to leave the others out of this, but give you some from the front discussion. Yesterday I saw a lot of investors. They were a lot of energy focused investors. That is a sector of investment that or investors that we're looking for in the competition for capital to come into my stock. You can be in your stock and your stock, but as far as my peers go, I want you in my stock. So I want to listen to them, and it is the energy sector that said at one point leverage was too high. And they asked energy companies and energy transport companies like ourselves, reduce your leverage. But I was hearing, you're low enough, and maybe you can go up. So that's what it's all about, is our job as public companies is to win that competition for capital and get investors into our stock.
I guess eventually the leverage strategy is also a function of what's your employment profile looking like. So from Ole's perspective, right? If I just extended my container vessels 5 years with Maersk, then obviously we would also be looking at higher leverage, and that's what we did, right? So on our new builds, when we have 7-15-year time charters, we're more than happy to look at 75-80%. We've just recently seen 100% financing, which is, it's crazy in itself. Which tells you something about the lending market right now. But I guess it's always a bit of a trade-off. What's the employment profile and how much spot exposure you take on the shipping market.
Well, let me know if you're looking for a reasonably priced debt.
Yes, and would you tell us where to find it? Because I don't know if it's with you, my friend. But
But Ted, you just raised capital, didn't you?
I did.
Yeah.
Personally.
If you want to invest it, I can help you.
Perfect. Thank you very much indeed. That's good to know.
But to work safely.
Safely, exactly. It's basically like a bond, government bond, exactly. Hopefully
Are you going to dividend him more than he can make when he deploys that capital somewhere?
Over time, 20 years, 13% the annualized return.
That's very well done. SFL is the ticker symbol, everyone, if you're wondering. But I think the other thing that goes in this equation, right, is we were all spoiled. The world was spoiled by basically free debt for a long time, and that has warped the reality a little bit. And so we got approached by one of our house banks with a very attractive margin, and that was great. Everyone borrowed a low margin, but it's like, God, this is like 7% money with SOFR the way it is. So it really does affect your capital budgeting and everything else. So
this is just like it was 2 weeks ago, except without the gin and tonics and rosé. So, so one thing I would throw in from the banking standpoint is obviously not making the same decision that you guys are, but when you are a company that is potentially under attack and you're trying to defend yourself, I will say that capital allocation is at the crux of whether or not you have a defensible case or not. So just it's something that is more than just theoretical. It affects a lot of things that you may not expect to be coming your way. So just to throw that out there. So next topic, I mentioned interest rates at the beginning. We've been in a rising interest rate environment for the last few years. We were in a very neutral interest rate environment for many years prior to that. But if you believe market prognosticators, we're about to be in a declining interest rate environment at some point, maybe later this year and for the next couple. How do you guys think about that same decision, the same talking point in a declining interest rate environment, whether it has something to do with new building costs, whether it has something to do with, hey, am I paying enough dividends? Are my dividends worth paying if interest rates are declining? So now that we're about to transition, we'll talk about cyclicality in a minute. Some of you guys already addressed in terms of diversification, but I'm talking about a change in the interest rate environment. How does that affect this particular topic? Ole?
Yeah, again, just speaking for ourselves, we typically hedge out the interest rates. So we don't really play the interest rate market. If investors want that, they can do it themselves. So we do a deal, we typically finance it, try to match financing and match interest. What I find interesting from a shareholder return perspective or shareholder expectation is that that's relatively static, irrespective of interest rates. So I think this has to do with the kind of investors or the type of investors who are investing in a cyclical industry. These are not sort of a little margin over the interest rate, the floating interest rate. They have absolute returns. So I think now in many asset classes, for instance, in the leasing business, now it's much easier to do business now than it used to be when LIBOR was 1%. We don't do that. We used to do it, for what we believe are really good reasons. We really stopped doing it. But it's kind of interesting to see that even if interest does come up, investor expectations doesn't move much. Do you see the same?
The quick answer is just, yeah, we hedge out too, so our interest rates we're always about 85% covered. And I really don't find it that interesting, Doug, no offense, but I mean, interest rates went up, now they're going to go down. The main thing is not to get caught out with a much different interest rate than your competitors. So don't leave yourself vulnerable, but otherwise, if we're in the same interest rate environment, that debt's still cheaper than equity, and we can use the debt that's out there, it's all good.
Right. Well, maybe taking a different direction, impact of interest rates on asset values. It's cheaper financing or, relative return expectations of investors.
I mean, I'd say I think we've all talked about it a lot, formally and informally. The rising interest rate environment seems to have had very little impact on shipbuilding prices. There was a lot of rationalization of yard capacity, and yards are full. And it's not just VLGCs or LNG carriers or container ships. I mean, there are a lot of sectors that have really built up. So it's almost immune. The shipbuilding sector is going through its own little cycle, and they seem to be relatively immune from rising interest rates. And I think a lot of folks have cash on their balance sheets and are able to say, I'll pay it out of cash on hand. I'll take less debt. If you're driving to a cash cost per day, you may have to, in theory, over-equitize versus what you might have done historically. But, the rates, of course, rates are not at all correlated with interest rates for the most part. I mean, there may be some coincidental correlation, but it's not causal. So, from our perspective, the only big difference has been with this interest rate environment, and even if it moderates some, you actually can park cash on your balance sheet and earn a little something for your investors, as opposed to a zero interest rate environment. Then we're like, what are you doing?
Right. And Svein, this may be more impactful for you guys.
Yeah, I mean, I'm kind of in Jeff's camp as far as how we look at interest rates. It doesn't really matter that much to us because we, as I mentioned earlier, we don't apply any leverage at the fund level, so we just invest equity. We're just targeting a certain return on everything we do. So whether we're issuing a loan, fixed rate, floating rate, we always just target the same return. And if we do a floating rate loan, we price it off the curve. But fair to say that as of late, we've been doing mostly fixed rate loans. But and I think to Ted's point here earlier, it's quite clear that we haven't spoken for a few years because when you're probably referring to the day when interest rates were close to zero. The gap between banks and where we are has definitely narrowed substantially. So maybe it's time to talk again. So, but yeah, the interest rate environment doesn't really impact us that much. We are obviously looking to extract a little bit extra return when the interest rate is 5 or higher, as compared to 0, just over 0, but certainly not commensurate. So yeah, so that's how we look at it.
Moritz.
Yeah, just to answer the question on interest rates. So it's a bit of a mix on our balance sheets. On a long-term project, we have a tendency to lock in the interest rate, but on a more short-term basis, we keep it floating in the expectation that in the foreseeable future it might come down further. But obviously, it also impacts, the new business approach that we have. If you do, if you throw the numbers into the Excel spreadsheet and try to make sense of the numbers, then obviously the leverage and the high interest rate make an impact. But what people, tend to forget is that also, on the operational basis, on the OPEX and CAPEX side of things, costs have been increasing 30-40% over the last 2 years. So it's becoming, not only because of leverage or the interest rate environment, it's becoming increasingly difficult to make sense of new projects. So it's you have to search much longer to find the right project.
Gotcha, thank you. And cognizant of the time, so we've already touched on diversification, cyclicality, dividends, et cetera. I could ask about buybacks, but that answer is pretty obvious. So just the final question is, any closing remarks, anything that we haven't touched on that you would like to touch on, or anything that you want to leave the audience as it relates to how each of you guys think about the billion-dollar question of capital allocation?
It's very simple. As you pointed out, it's the billion-dollar question. I think Ted here has the billion-dollar solution. Like right there.
Thank you. This has been a wonderful pitch for SFL. I'll be sure to put some in my IRA and recommend it to all my friends.
All right. Jeff, Svein, Moritz?
I think we are probably less focused on equity these days because it's honestly hard to find good deals. We actually been selling more than buying as of late. So we focus a lot on issuing loans these days, and we have done a lot, for instance, in the offshore oil services sector, where we see very little capacity from the banking side, which is great. So we've done a lot there. We have not issued another loan in the container sector for I think about 3.5 years now. So we completely backed out of that when that market went crazy during the pandemic. Once things settle in the Red Sea, we expect the container market to keep falling again, or start falling again, sorry. But at some point we'll get back into that, but right now we're more focused on the offshore oil services sector.
Okay. Moritz?
I would probably, from an investment perspective, probably always look fundamentally at the order book, regardless of the segment. And, having said that, and, listening to Sven's comment on the demand side, the container might not be the right place to be, given the order book. However, looking at the feeder market, the dynamics are a bit different. But, just from looking from order perspective, it's probably the dry side, which could be very interesting going forward.
All right, fantastic.
Wait, I engineered the last word for myself.
Yes, all right, there you go.
I'm the longest standing marine money guy. Come on. So $1 billion is not a random number. Thanks for picking it. With $500 million of undrawn revolver and 40 unencumbered ships, that's an amount of money we could spend. But we will be very careful about the way we look at $1 billion, and what we'll be doing is paying back shareholders while we're waiting to spend that money.
Fantastic.
We'll put it in SFL.
Yeah, there you go. All right, that does
There's always that.
Guys, thank you very much for your insights. Thank you.
Thank you. Thanks.